You know that saying, you can't believe everything you see on the internet? Well, it is especially true when it comes to mortgage information. But luckily, I'm gonna debunk the top 10 mortgage myths so you don't have to. Number 1, you need to put 20% down. Now, depending on your specific situation, you can put as low as 0% down to as high as 5% down as a minimum down payment. Now let's break this down further. 0% is if you're a veteran. 3% is if you're a first-time home buyer or if your income is below certain area median income limits. 3.5% is if you go into an FHA loan, and 5% would be if you don't meet any of those other criteria or if you didn't want to be in an FHA loan. Number 2, you need to have perfect credit. While 620 is typically the minimum thresholds, you can get approved with a credit score as low as 580. Now, you're gonna have to go into an FHA loan, and you may need other compensating factors, such as a bigger down payment or extra reserves, but it can be done. Number 3, you can't get a mortgage if you have student loan debt. Now, student loan payments count the same way that any other monthly reoccurring liability does. So this is no different than you having a monthly car payment. Now, you may be saying, my student loans haven't required payment in over a year now. So in this particular case, we still have to count a portion of the remaining balance, but it's not as bad as you think. So depending on the end loan, we're either gonna hold 0.5% or 1% of that remaining student loan balance against your monthly liabilities. Number 4, you can only get a mortgage from a bank. If this were true, I wouldn't have a job. Not only can you get a mortgage from a bank, you can get it from a correspondent lender such as myself, a credit union, and you can even get it through your own private investor. Number 5, you should always choose the lowest interest rate. While this is a very important factor to your loan, you also need to consider the loan terms and the other costs associated with the loan. The interest rate may look great on paper, but you may be paying a hefty fee in exchange for that rate. Number 6, getting pre-approved means that you're guaranteed to get a mortgage. Now, when you work with myself and the Anderson team, that pre-approval is about as close to a guarantee as you're gonna find. However, there are still things that could happen between the time of being pre-approved and the time of actually closing that loan. So although it's pretty close to a guarantee, it does not guarantee you that mortgage. Number 7, mortgages are only offered in 30-year terms. Now, while this is the most common term that you'll see on a mortgage, you can absolutely get a mortgage for a different term if you still qualify. So a good example is you may get a 15-year mortgage instead of a 30. Now, the benefit here is that you're usually going to get a better interest rate. However, because we've shrunken the payments from 30 years to 15 years, you got to know that the trade-off is that your monthly payment is going to be higher. However, you're going to pay the mortgage off quicker and you're going to pay less interest over the life of the loan. Number 8, you're stuck in your mortgage for the entire term. So for example, if you got a 30-year mortgage, you would be stuck in that mortgage for the next 30 years. Now, this is not true, and a couple of things can happen. The first, you may sell that property before the next 30 years, in which your mortgage is paid off. Hopefully you made a little bit of money and you walk away with some cash. But what's more likely to happen is that you're going to refinance before that 30 years is up. So what happens is, after you've made 6 full mortgage payments, let's say the interest rates come down and you want to take advantage. You would refinance out of that original loan, and now you would have the new terms of the new loan per the refinance. Number 9, you can't get a mortgage if you're self-employed. Now, it's going to require that you submit some additional documentation, which is standard across the industry for self-employed borrowers, but you absolutely can get a mortgage if you're self-employed. Number 10, you can't shop around for a mortgage. Just like you would shop for any other commodity, you can absolutely do the same thing when it comes to your mortgage. However, I'm going to give you a couple helpful pieces of advice. Number 1, this comes during the pre-approval process. You can have up to 3 lenders pull your credit within a 30 to 45 day window max, and it will only count as 1 credit pull. So this is how you safeguard your credit from getting 3 hard inquiries. Now at this point, you could get pre-approved from all 3 lenders, but you don't have to decide who you're going with. What you should do from here is go out, shop for a home, and once you have an accepted contract, go back to all 3 lenders and ask them to provide a loan estimate with their best rate and terms on that loan. You can then compare the 3 to make sure that you are truly getting the best deal, and that's how you win big. Well, there it is, the top 10 mortgage myths debunked so you don't have to. If you enjoyed this video, please comment, please like, please subscribe to the page. Let me know what future mortgage content you want to hear about, and I would love to make that happen for you. We'll see you on the next one.